So good evening, everyone. We want to go on and at least clear off some of the remaining standards. I think we are left with IAS 21 to deal with. We have to deal with IFRS 15. We have to do with IAS 37. We have to also go through and do IAS 33. All right, so these are the standards remaining for us. And I want to see how best I can strip some of them off by looking at them quickly. So we want to go ahead and look at IAS 21, which is effect of changes in foreign exchange rate. I think in the times that we are in now, it has become so eminent that we understand this, especially if you are a Ghanaian now, then it means that you need to really understand how these things operate in your financial statement, okay? All right, rates keep changing every day. So we want to look at the changes, the effect of the changes of these exchange rates, foreign exchange rates on our account, all right? And our main objective today is to actually be able to deal with this part, functional and presentation currency. Because if your exams is coming and it is not about the numbers, the only way that they can examine you is about determination of the functional currency. Very, very important. So we want to look at the effect of the changes. And first and foremost, the standard as I presented it here in this table is looking at three perspectives or three angles. We are looking at one, the exchange rates. We want to define them. Okay, so like we always do, we always talk about definition, recognition, measurement. That is how we deal with it. Now, if we want to define these items that have been tabulated on your screen, then we need to start here from the historical or the spot rate, all right? So in case you are doing any transaction, the rate that is in place as at the time that you are doing your transaction, all right, is what we call spot or historical rate. So spot or historical rate is the rate in place, okay, at the date of the transaction, all right, at the date of the transaction. So what was the exchange rate as at the time that you were transacting? All right, you need to have a source. All right, people use XC, people use Bank of Ghana, EcoBank, Owando or Wanda, whichever way you want to go use as your source. The spot rate is the rate as at the time that you were doing the transaction. So that is the rate, okay? That is the rate. So if, for example, today, it said that exchange rate is already at 15. So you have 15 cedis. So you have $1 being equal to 15 Ghana cedis. All is well in our country. So that is how it is. So it will take you 15 cedis to get $1 US. All right. So if you are doing a transaction today, all right, this exchange rate becomes your historical or your spot rate, because if you are having a transaction today, then that is your spot rate. Okay. Now, what is the closing rate? Closing rate is actually the rate at the reporting date. So you have your accounting year. So if, say, accounting year is January to December, any transaction that you'll be doing in this period will be using the spot or the historical rate, okay? So that is how the transaction is going to be. Now, if the year ends, the last day on 31st December, there will be a rate to close the year, and that is what we call the closing rate, all right? So the rate at the reporting date, all right, 31st December, is the closing rate. Okay, so that is that. I remember being an officer and working in petroleum warehousing and supply. My boss will make me do an Excel template in which I will be doing the average of the exchange rate month by month, all right? So we have an average rate, and the average rate is, you will have to average the rate that is coming. You are these rates, that the historical rate or the spot rate that you've been using throughout the year, okay? So what happens is that I will create an Excel sheet and I'll be finding the average per month. At the end of the year, I find the average also of the year. So what the average is about is actually a weighted average rate throughout the accounting year. All right, so these are weighted rates for these historical or export rates. So that is how the rates are. So you have to keep this in check, because every day when a transaction is done, and it has to be done in by translating or converting it in terms of the currency, it is the spot rate. All right. At the end of the year, we will be doing some adjustments, and that is why you may need the closing rate or the average rate. All right. So that is that. Now we have, concerning the assets and the liability, we have two types. We have the monetary assets, okay, monetary item and non-monetary items. The monetary items are those that can be easily converted to cash. A typical example are your trade receivables, your payables, right? Your loans. Okay, so these are monetary items. Okay, they are monetary items. They can be easily converted into cash. Easily is the key. Easily converted into cash. Then, in a sense, we are saying that it also gives the right to receive or deliver cash. Okay, so it also gives right to receive cash and obligation to deliver cash. All right, so these are the monetary items. Coming here to look at the non-monetary items, we are saying that non-monetary items are items, all right, this gives no right they give no rights to receive or deliver cash. All right. As a matter of fact, it will be very difficult to convert them into cash. All right. So they are not easily converted to cash. All right. So these are non-monetary items. A typical example are our inventory and also our PPE. These differentiations are very, very important, because we will need them later in this study that we are doing. We will need them very soon. We will need them. So keep this in mind. There is a need to distinguish between monetary items and non-monetary items, because the treatment of monetary items is different from non-monetary items. All right. So if you don't know anything at all, then you need to know that receivable, payable loans are monetary items. They can be easily converted to cash. All right. Then all the others other than these mentioned non-monetary. Example, our inventories and our PP. All right, so take note of that. Now, we now need to understand what a functional currency is and what a presentation currency is. I will deal with the presentation currency and lay it on because there has been past questions on functional currency, so that I take my time and do that. All right. So what is a presentation currency? All right. Presentation currency is the currency with which you present your financial statement. All right. So for example, if you are preparing a single entity financial statement, you will see that a CD is at the top of it. Okay, so that will be your presentation currency, the one that appears on your financial statement. So we say that presentation currency is the currency in which the financial statements are presented. All right, so that is the presentation currency. Okay, that is it. So if you prepare account, the currencies that you see at the top, the ones that we are telling you that never omit them when preparing your financial statement because you carry marks, those are the ones that we are calling presentation currency. Then we have the functional currency, and this is a little dicey. All right, so this is what I'm going to do. I'm going to define it here and open a fresh page and we discuss it further. Now, the functional currency is the currency of the primary economic environment. Primary economic environment in which the entity operates. All right, so it is the currency of the primary economic environment in which the entity operates. All right. Okay, so herein what we are trying to say is that usually it is the currency in which majority of the entities transactions take place. Okay, so that is where we can say this is your functional currency. Okay, so we say that the currency in which majority of an entity's transaction take place. Okay, so that is the functional currency. Now, somebody will ask, we are Ghanaians, we are living in Ghana. Our currency is CD. Yet, we are still talking about dollar. Why? So why are we not sticking to our CD? Why are we not doing everything in CD? And that is where the problem is coming from. It's coming from our functional currency, the functional currency of some entities. So if you see the confusing state is coming from this. Now watch this. It says that it is the primary currency, the currency of the primary economic environment in which the entity operates. So for instance, this can be Ghana. All right, and the currency of the primary economic environment of Ghana is actually in cedis. All right, it didn't end there. We said that it is the currency in which majority of the entity's transaction takes place. Now, this part is where it brings about the confusion. So you can be in Ghana, which is a cedi company, but you will be trading in dollar. And this is where we are now. So you ask yourself, if that is the case, then which of these is actually the functional currency? That is where the problem is. Because the economic environment of the entity is Ghana, and the currency of that economic environment is Ghana cedis. Herein, there is a company in Ghana whose majority of transaction is in dollars. So which one is the functional? So that is the question we need to ask ourselves. And that is where past questions have been examining students. So it gives you these two scenarios, and you are asked to fish out which one is the functional currency. Okay, so that is that. And how are we going to distinguish between these situations? If the economic environment is having a currency, yet the majority of the business's transaction is in another currency, then which one is actually our functional currency? Okay, so that is what we need to actually go at. All right, so let's see how we can actually determine the functional currency. All right, so what the standard says is that in those situations where the functional currency becomes very difficult to determine, there are two ways that you find out. We have the primary factors, and we have the secondary factors. All right. Now, what are the primary factors? What are the primary factors? The primary factors are, number one, the currency. The currency that influences the sales prices, all right, of goods and services. All right, so which currency that influences the selling prices of the entity, of their goods and their services that they are rendering? Which currency is that? Is it the dollar? Is it the cedi? So that is the primary aspect. And number two, we have the currency of the country whose competitive forces and regulations mainly determine these selling prices that we are talking about. So here we talk about the currency of the country whose competitive forces. And when we say competitive forces, we are talking about the demand and supply. All right, the demand and supply. Whose competitive forces and regulation mainly determines the demand and supply. Or the sales price of goods and services. All right, so you will see the primary factors by identifying the currency that influences the selling prices. You also see the currency of the country whose competitive forces and regulations mainly determine the selling prices of goods and services. All right. Lastly, of the primary factors, we are talking about the currency that mainly influence the factors of production. Mainly influence the factors of production. And the economists will tell you the factors of production are labor. They are talking about materials and labor. All right, so that is what we mean. Well, there may be other costs. Let me just state here. All right, so if you want to know the functional currency of so for instance, if you want to determine this functional currency, we said that look at these primary factors, the factors of labor or factors of production. All right. Also look at the countries whose competitive forces are determining the forces of demand and supply, and the currency that influences this. So typically in a Ghana situation, that is what you have, where here everything is in cities. So everything you do is actually in cities. And so your selling price will be in city. The country in which demand and supply is done is in cities. All right. The factors that the currency that influences factors of production is also in cities. But like I said, you may be in Ghana. So you see that the currency that influences selling prices is in cities. Okay, and selling prices of goods and services is in cities. The currency of the country here, for example, in Ghana, will also be in cities but the currency that mainly influences the factors of production. These days, if I ask you now, if I'm employing you, will you take cedi or dollar? Will you say you take cedi? No way. You will always say you want the dollar. So it means that two of these will be fulfilled, but one, the third one will not be fulfilled. If there is a discrepancy in the primary factors, then we can only identify the functional currency through the secondary factors. Okay, and what are the secondary factors? The secondary factors, we have one, we are talking about the currency in which funds from financing activities are generated. All right. So we say the currency in which funds from financing activities are generated. Okay, so if somebody is to push money inside the entity, in terms of investing into the entity, or you are going for a loan or anything, which currency will you take the loan? So if there is a confusion amidst the primary factors, then you ask yourself, if the entity is going to borrow funds, which currency will it borrow? Which currency will it get the funds? All right. So if that one, if there is inconsistency in the primary factors, then you ask yourself this question. The one that achieves it will become the functional currency. We said number two, the standard also says that the currency in which receipts from operating activities are retained. Okay, so there are some companies in Ghana, immediately that they get the cedis, they don't keep the money in cedis. They now convert it in dollar, because the currency within which they retain their receivables, their cash and everything is actually in dollar. Even though they collect cedi, they turn it into dollar. So the currency in which they retain those monies that they have received from their operating activity then becomes the functional currency. All right. So if there is confusion amidst this part, then you need to go to the secondary factors. All right. So I want to leave the time remaining, the 6 minutes remaining here. or any questions that you want to seek to clarify. All right. So any
No, sir.
questions?